Hello everyone, welcome to Module 2 on Financing with Confidence. If you have not yet, I highly recommend that you go back and check out Module 1, which lays the foundation for what the home buying process looks like, walking through steps, and I think just it lays a good base for what we're about to jump into now. My name is Dr. Kevin Shuford, the property professor. I have a Ph.D. in communication, and I'm also a licensed real estate agent and mortgage lender in both Arizona and California, but I have referral partners across all 50 states and internationally. I will be your guide for this, so let's go ahead and jump into this lesson. All right, so let's jump into lesson 4 in module 2. So this is on understanding mortgages. And so in this lesson, what we're going to do is we're going to demystify mortgages overall. So if you've heard terms like FHA, conventional, ARMs, fixed, things like that, it might sound kind of complicated. And if that's the case, then you are not alone. Do not worry. By the end of this lesson, you'll understand the main mortgage types, their pros and cons, and which one actually might be the best for your situation. So I am Dr. Kevin Shuford, the property professor. Let's go ahead and jump into this. So your mortgage is probably the single most important financial decision that you will make in the home buying process. This is going to cost you tens of thousands, hundreds of thousands more likely, potentially millions of dollars. And that is a really big decision. So the type of mortgage that you choose is not only going to affect your monthly payments, but it can also affect your long-term wealth building. Ideally, when we purchase a home, we do want to try to build some wealth. And so your mortgage really is a vehicle for generational wealth building. So some loans have some more money up front in terms of costs, but that costs potentially more later. And so other people or other mortgage types are going to give you more stability, but they might have a higher down payment. And so knowing the differences between these is going to help you match which loan type is going to be the best for your lifestyle and your timeline, as well as your financial situation overall. So let's go ahead and dive into this. First up, let's talk about fixed rate mortgages. So this is exactly what it sounds like. Your interest rate is going to stay the same for the entire life of the loan, whether that's going to be a 15-year, 20-year, 30-year mortgage. There are also some 40-year mortgages now that are being floated, so kind of be on the lookout for that potentially. But the 30-year fixed mortgage is the traditional mortgage overall. And so the big advantage with a fixed mortgage is that you have predictability. And so your monthly principal and your interest amount is never going to change, even if the market rates skyrocket, or even if they decrease, you could then refinance and get a lower rate. But if they do go up, you're not actually going to have to pay more money. And so a fixed rate mortgage is ideal if you plan to stay in the home for long term, or you are someone or you're someone who values that stability. But the trade-off here is that sometimes with these fixed rate mortgages, that interest rate might be a little bit higher than adjustable rate mortgages. But once again, it gives you more stability and more security. Next up, let's talk about adjustable rate mortgages, or ARMs. These ones can be very beneficial for you potentially, but they also have some pretty big caveats. So oftentimes when the market interest rate is high, an ARM could be a good decision because it starts with a lower interest rate for a set period of time, usually 5, 7, or 10 years. And then after that period, the rate is going to adjust based on what the market is doing, what the market rate looks like. So for example, if you were to see something that said 5-1 ARM, a 5-1 ARM means that your interest rate is fixed for 5 years, and then it's going to adjust once per year after that. And so the upside here is that you save money early on, but the downside is that if you hold on to the loan for too long, your rate could rise. And so if you're going to pursue or think about going with an ARM, then it is best typically for people who know that they're going to either move or refinance before that adjustment period kicks in. Let's talk about FHA loans. An FHA loan is backed by the Federal Housing Administration. And so these loans are pretty popular with first-time home buyers because you can usually qualify with a lower credit score down in the 500s, even 580 typically is what you'll see there. And so you can qualify with a lower credit score and a down payment as little as 3.5%. You do not need 20% down payment to purchase a home. That's one of the myths that we talked about in Module 1, so go back and check that out because that is not true. So unfortunate part here, the trade-off here is that you're going to have what's called mortgage insurance. And so you're going to pay an extra monthly fee that's going to protect the lender. And so unless you put down at least 10%, this mortgage insurance is going to stay with you for the life of the loan. And so that's very important to note. So if you go with that 3.5% down, then you're going to be stuck with that mortgage insurance for the life of the loan. And so a way to get out of this is to refinance into a conventional loan, which we'll talk about here shortly. So that's one way to get rid of it. Or you could potentially your loan is also then assumable with FHA loans. And so someone can come in and take over your payment, and then you could go and buy a different house with the equity that you've built up. This is a little more complex. We can get into that later as well. So FHA is going to be perfect if you need an easier entry into home ownership, but it's not necessarily going to be the cheapest option long term unless you're going to get out and refinance into a different loan type. The conventional loan is next, and this is one of the most common types of mortgages. So here you can get into a home with as little as 3% down or 5% down typically, and you tend to qualify for these if you have stronger credit and stable income. So if you have a credit score of above about 620, that's ideal here to qualify for conventional, but the higher credit score that you have, the better rate you're going to get as well, up to a certain point, and then that's going to therefore impact your monthly mortgage payment. So the big advantage here, once again, is that you do not have to have that 20% down payment. But once you do reach that 20% payment or that 20% equity mark, you no longer have mortgage insurance. So with the FHA loan, that mortgage insurance is going to stay on for the life of the loan. But with conventional, once you reach 20% of equity, so say for example you put a 10% down payment, and then over time you have paid that loan down and your house is appreciated in value to where now you have a 20% loan to value ratio or 80% loan to value ratio, that would then allow that mortgage insurance to fall off, which could save you $100 to $250 potentially, depending on what your mortgage looks like. So the conventional loan is going to be great because it's going to give you more flexibility as well in terms of if you want to buy condos or second homes, investment properties. The conventional loan really is very versatile and has less restrictions than the FHA loan. And so it's good to think of the FHA loan as more of a starter loan and the conventional one as more of a long-term builder. So if you're just trying to get into the market, FHA is a pretty good way to go. But if you can qualify for a conventional, then that is typically what we'd recommend that you pursue. This one is for our veterans, the VA loans. So this is exclusively for veterans, active duty military, and eligible surviving spouses. And so if you qualify for a VA loan, this is one of the best deals out there by far. So it requires a 0 down payment. So with conventional, we said 3%. With FHA, we said 3.5%. This is a 0 down payment, right? That is crazy. There's also no mortgage insurance that is tied to this, which is going to help save on your monthly payment. And you typically have a lower interest rate, oftentimes by about 0.5%, which is really great. I mean, I love it. So the catch here, though, is the eligibility factor. It is only it's only available to those who have served, but if you do qualify, it is almost always the smartest option. There are some restrictions and limitations, some income or some home value caps that exist, but those are, we can have a further conversation about that if you're interested in pursuing a VA loan. I highly, highly recommend. These loans are also assumable, similar to the FHA loan, so you can, if someone has a VA loan, you can then step in and assume their mortgage, take over their payments and their rate, but the veteran then would have to accept you stepping in to take it over because they would lose some of the value that they'd have in their VA loan entitlement. So it can get a little tricky, but if you are eligible for this, then I highly, highly recommend that you look into it. All right, so let's just put these side by side with this comparison chart here, just so you can see what the different terms are and how they differ overall. So fixed rate, once again, these loans are going to give stability, but oftentimes have a higher starting rate. And then you have the ARMs, which are the adjustable rate mortgages. These ones are going to give you the lower rate at first, but then it can rise later. So if you do an ARM, then you should try to make sure that you have a plan before that adjustment kicks in to make sure that you're not paying more overall. Next, you have FHA. These loans are easier to qualify for because they have lower credit limits. So in the 500s, about 580 ideally, potentially lower depending on who you're talking to and what your credit profile looks like, your financial profile looks like. But this is going to be great for first-time home buyers who need maybe a little bit more assistance. But the downfall here is that these loans do come with mortgage insurance that is hard to get rid of unless you refinance into a different type of loan. The conventional mortgage is going to be the one that offers you long-term flexibility, especially if you have stronger credit above 620. Higher is even better. This is going to allow you to purchase more homes, condos, investment properties, second homes with much more ease than an FHA loan would. And then finally, you have the VA loans. If you are eligible, this is the gold standard. It is unbeatable. You have a lower interest rate. You have a zero down payment. You have no mortgage insurance. It is such a great option if you qualify. So the key takeaway here is that you should be trying to match your loan type to your financial situation and how long you plan to stay in that home. And so if you're unsure about which one works best for you, then let's have a conversation and try to figure it out. Let's take a look at an example of what the different loan types are going to look like with a $400,000 home price. So with an FHA loan, you might put down 3.5%, which is going to be about $14,000. But that mortgage insurance, once again, is going to stay with you for the life of the loan. So that's going to add potentially a couple $100 to that monthly payment. With a conventional loan at 5% down, that would be $20,000 up front. But once that loan value hits the 80% mark or 20% equity, that mortgage insurance is going to fall off, and so you're actually going to be saving money every month. If instead you go with a 5/1 ARM instead of a fixed rate mortgage with either FHA or conventional, then you could save about $150 per month in the early years. Then once that fifth year kicks in, then that rate could adjust, and so you could end up actually paying more unless you refinance or sell before that adjustment period hits. So each path is going to have trade-offs, and so that's why planning is very important. There is no one size fits all. It really just depends on what your financial situation looks like and what your plans are for that home. Let's do a quick recap here. So fixed rate loans are going to be perfect for long-term stability, while ARMs or adjustable rate mortgages work best if you're planning shorter term ownership or expect to refinance before that adjustment hits. An FHA loan is going to help buyers with lower credit scores or smaller down payments amounts to get started, to get into the home, while conventional loans are going to reward those with stronger credit and offer with more flexibility and potentially lower long-term costs with that mortgage insurance that will fall off versus mortgage insurance staying on with the FHA loan. VA loans, once again, hands down the best options for those who qualify. 0% down payment, lower interest rate by about 0.5% from market rate, and no mortgage insurance either. So if you qualify, that's the one you want to go for. But remember, there is no one size fits all. It's, once again, the right choice depends on your timeline and your goals. Congratulations, you made it to the end of lesson 4. Next up, we are going to chat in lesson 5 about how seller credits and concessions work. This is one of the smartest, best ways to help save buyers money, especially in today's market. If it's a buyer's market, then this is a really great advantage. If it's a seller's market, I still recommend that you try to pursue these, but I will show you how some clients can cut their cash to close costs and potentially lower their monthly payments by hundreds of dollars. You're not going to want to miss out on this, so hit that subscribe button and we'll see you on the next one. A few things before you go. I would really appreciate it if you would like this video and also subscribe to the full Real Estate and Mortgage 101 series. Also, just for watching this, if you're interested in having the full Module 2, go ahead and click the link that's in the description down below and you'll get all of these resources for free. So you'll get this entire playback, you'll get the PowerPoint slides, and then in that I also have a lot more resources for you. It's my special treat for you just for watching free of charge. I know that this can be a lot, but you can do it. I will help you walk through every step of the way. Thank you. Very quickly before you go, I just want to say thank you for taking time to listen to this lesson. I know that financing can be a tricky subject, so if you found it interesting or helpful, then please I encourage you to like and subscribe. If you're interested in working with me, I am a licensed agent in California and Arizona, both a real estate agent and mortgage loan officer, but I do have referral partners across all 50 states and internationally. So feel free to text me, call me, email me, whatever works best for you. I'm here to help. Take care. Hello everyone, welcome to Lesson 5 of the Real Estate and Mortgage 101 series. My name is Dr. Kevin Shuford. I am a licensed real estate agent and mortgage lender in Arizona and California, but have referral partners across all 50 states and internationally as well. Today we're going to be covering one of the smartest hacks in home buying, which is asking for seller credits and concessions. And so the strategies you're going to learn here can help reduce your cash to close and can even lower your monthly mortgage payment by potentially hundreds of dollars. And so most first-time home buyers don't even know that this is possible. But let's go ahead and break it down in Lesson 5. So on the title slide, I alluded to why this is important, but just as a quick preview here, when you buy a home, every dollar matters. And you probably are aware of this if you've been thinking about buying a home. How much money do I have right now? How much house can I afford? What's my monthly mortgage payment going to look like? How much money do I need to actually close? What the down payment's going to be? Are there any extra fees? All these questions are spiraling in your head. And so too many buyers oftentimes think that they have to pay every single cent out of pocket. But this actually is not true. The truth is that if you're engaging in smart negotiations, hopefully your agent is doing this for you, that can actually shift thousands of dollars from the seller side to your side. And that will then make the process much more affordable and smoother, and you'll just be happier overall. I mean, who doesn't love saving money? And so this can really be the difference between feeling stretched thin when purchasing the home and feeling comfortable finding that first home and settling into it. First up, let's go ahead and discuss seller credits. So what are seller credits? These are going to be funds that come from the seller that they agree to contribute towards your closing costs. So it's very important to note that these funds do not go directly into your pocket. Okay, you cannot keep any money left over from the seller in this instance. But they can reduce the amount that you're going to need to bring to the closing table. And so seller credits can cover things like loan origination fees, title costs, prepaid taxes, homeowners insurance, and can even be used to help lower your mortgage rate with the mortgage rate buydown. And so this is actually a really great strategy for high interest rate markets where you can get a couple extra $1,000 from the seller to bring your rate from a 6.5% down to a 6%, which could save you potentially a couple $100 right there. And so think of this as the seller is chipping in to help make the deal work for you. And so this is only really going to happen if your agent is able to negotiate for these, if they ask for them on your behalf. And so if you're purchasing a home and now you're aware that these exist and your agent has not suggested them, bring this up and say, hey, what about getting some seller credits to help with my closing costs? The other important term here is concessions. So what are seller concessions? These are going to be a broader term. And so concessions do include seller credits. So a seller credit is a type of concession. But they also can cover things like repairs after the inspection is done, covering HOA fees if you're living in a community that has an HOA fee, and they potentially can help offer price reductions instead of fixing the items that show up in the inspection report. And so essentially a concession is any way that the seller is trying to make the deal move forward or make the deal easier for the buyer. And so the flexibility here can make the home much more affordable, especially in slower markets where maybe sellers are more motivated. So if interest rates are really high, if there's a lot of inventory, then concessions are a great way to go. Getting seller credits are going to be used directly for those closing costs, but the concessions just generally as a term cover a wide range of items. So how much money are we really talking here in terms of seller credits? What is the average usual credit that buyers can receive? Typically, seller credits are going to range between 2 to 3% of the purchase price. And usually the reason for this is because your closing costs are going to be about 2 to 3% of the purchase price as well. And so essentially what is happening here is you could go into buying a home and you say on a $400,000 home, you're going to do a conventional loan, 3% down. You can get 3% from the seller in credits to help cover those closing costs. So you're coming in with just $12,000 out of pocket, and that's it. It covers all your closing costs, and then if there's any left over, it can be used to help buy down that interest rate. However, it really is going to depend on the loan type that you have, because there are certain limits on how much credit you can receive. And so, for example, can get a little technical here. So let's start with conventional, because it's the hardest one. So a conventional loan, you can get between 3 to 9% of the purchase price in seller credits. However, you can only get 3%, up to 3%, if you put less than a 10% down payment. If you put down between a 10% to a 24.99% down payment, you can get up to 6% in seller credits. And then if you are able to put down more than 25%, you can get up to 9% in seller credits. For FHA loans, you can just get up to 6% just generally in seller credits. For VA loans, it's up to 4% in seller credits. And then USDA loans, which are more for rural type housing, you can also get up to 6% in seller credits. And so typically, regardless of if you're getting between 2 to 3%, it's going to be enough to help cover most of, if not all of your closing costs, and hopefully have just a little bit left over to buy down that rate a little bit. All right, so let's take a look at an example here. So a buyer purchases a home for $450,000, and closing costs are going to be about $9,000, which is 2%. So through negotiation, if we can secure $7,500, then the buyer's only going to have to come in with an extra $1,500 at closing to cover those closing costs. And so this is really great, because instead of thinking, oh, I have to have 20% down payment to purchase a home, which is $90,000, which I do not have personally, right? Instead, I can come in with a conventional loan if you have good credit and get in for 3% down, which is going to be $15,000, and then I only have to bring in an extra $1,500 for closing. So out of pocket fully, $16,500, I am in the door with my keys. This home is mine. And so on top of that, you can also, if there's any left over from those concessions, get either temporary rate buy down or a permanent buy down to help lower your monthly payment, either temporarily or overall long term, saving about maybe $300 in that first year. And so this really is a very valuable tool that you should be pursuing. You might be wondering why a seller would agree to giving concessions or credits to the buyer. The answer really is fairly simple. Especially in markets that are really tough with high inventory or high rates, if the house has been sitting for a long time, then offering that credit is often cheaper than dropping the home purchase price overall. And so, for example, if you were to lower the purchase price by about $10,000, that's going to barely make a dent in that buyer's monthly payment, maybe about $50 per month. But if you give the $10,000 credit instead, that can help the buyer cover closing costs, potentially partial or fully, and or reduce their monthly payment significantly. Buying down your interest rate is most of the time a better option than taking a price reduction. That's very important to keep in mind. Overall here, it is a win-win. The seller keeps their home value fairly strong, and the buyer gets real immediate relief. For buyers, this is an awesome deal because the advantage here is huge. You bring less money to the table at closing. You can use those credits to help either pay off those closing costs fully and or reduce your interest rate, which is going to make your monthly payments more affordable. And if you don't have to bring money to the closing table for closing costs, now you have extra money, hopefully, for things like furniture, repairs, building up an emergency fund. Really, this strategy is going to make homeownership more accessible and more sustainable. So instead of being what we call house poor, you become able to breathe and have more room in your budget. Let's do a quick recap of credits and concessions. So seller credits are funds that are used to reduce the amount of closing costs that you have. Concessions then are going to be a broader category that can include repairs or other financial help from the seller. Typically, you're going to get about 2 to 3% in concessions, and when you apply these to rate buydowns, it can lower your monthly payment by potentially hundreds of dollars. So it's going to help cover closing costs, so title insurance, mortgage fees, homeowners insurance, HOA fees, potentially repairs, All of these things are going to be potentially handled by the seller so you can save more money as that buyer. And it's really important to note here too that you cannot just put those concessions or credits into your pocket after closing. The funds have to be tied to something with the transaction. And so that is oftentimes a misconception, like, oh, why can't I just, if there's leftover, why can't I just put it in my pocket? That's not really how it works. But the key here is knowing how to ask for these benefits and working with a realtor that's going to understand how to structure them. If your realtor is not asking for concessions or credits, then you really should ask them why, because it is a way potentially for you to get some extra money back into your pocket by saving you on those closing costs. Congratulations, you have completed lesson 5 on credits and concessions. And now we're going to move into lesson 6, which is going to be the final lesson in module 2. So in lesson 6, what we're going to do is we're going to go deeper into one of the most powerful ways that you can use seller credits, which is the rate buydowns, talking about what a buydown really is, how they work for either temporary or permanent buydowns, and then deciding if it is going to be the right move for you. So definitely hit that like and subscribe button, and we'll see you on the next one. Very quickly before you go, I just want to encourage you to subscribe to the full Real Estate and Mortgage 101 series, because every week I'm dropping really valuable information for you if you're considering purchasing a home. And as my gift to you, if you click on the link that's in the description box down below, you can access the full Module 2 resources for free. So you get access to this video, to the PowerPoint slides, and as a bonus, there is a full vault of extra real estate resources that I think you will really enjoy. So please go ahead and check that out. It is, once again, fully free. And so I know this process can feel overwhelming, but I am here to guide you and help you every step of the way. Thank you so much. As a final reminder, my name is Dr. Kevin Shuford. I am the property professor. I have a Ph.D. in communication and I'm a licensed real estate agent and mortgage lender in both Arizona and California, with referral partners across all 50 states and internationally. If you'd like to work with me, I would love to work with you and help you get into a home or even sell your home. And so you can go ahead and contact me at the number on the screen. Text or call is perfectly fine. Feel free to email me as well. I am here to support you, and I'm looking forward to connecting. Thank you so much. See you on the next one. Hello everyone, welcome to lesson 6. This is the final lesson in module 2. If you have not yet had a chance, I recommend going back and watching lessons 1 through 5, just so you really know what is going on, just to catch up. But if you're joining us for the first time, my name is Dr. Kevin Shuford. I have a Ph.D. in communication, and I'm also a licensed realtor and mortgage officer in California and Arizona, and then have referral partners across all 50 states and internationally. Lesson 6 today is on rate buydowns. So we're going to be talking about one of the most powerful strategies that you as a buyer can use to lower your payment. And so you may have heard of a 2-1 buydown or paying points. You may not necessarily know what that actually means though. And so by the end of this lesson, you will know exactly how they work and how to use them to your advantage. So let's go ahead and jump in here. So before we dive into talking about what rate buydowns are and how they work, it's really important to note that these are one of the best strategies that you can use. In 2025, interest rates were pretty high, especially in the earlier months of the year, and the interest rate was really the biggest barrier for entry for buyers. And so a high rate can mean that you are basically priced out of being able to afford the home, or just your monthly payment might just be too overwhelming. And so the rate buy down is here to give you some options, and they allow you to reduce your monthly payment by either temporarily or permanently buying down the interest rate, and then you can use those savings to make sure that you're able to pay the difference between renting for another year and owning your first home. So I think that this is a very powerful tool, and now let's go ahead and talk about how they work exactly. So with an interest rate buy down, it is exactly what it sounds like. It's a simple way for you to pay down your interest rate, make that interest rate lower, which means that your payment is going to be better. And so this is funded by either seller credits, maybe builder incentives, or you can actually pay this down yourself if you have the extra money after closing costs. And so the idea here is that you're going to spend some money up front, either yours or the sellers or the builders, to help reduce that rate, and then also in turn reduce your monthly payment. And so there are two options here. Primarily they have the temporary buydowns and the permanent buydowns, And so we're going to dive into both of those on the next couple slides. First up, let's talk about the temporary buy down. The temporary buy down is going to offer a lower payment for the first 1 to 3 years of your loan. Typically, the most common is a 2-1 buy down, but oftentimes you also be able to see a 3-2-1 buy down potentially. And so let's take the 2-1 buy down example first. So in year 1, your interest rate is going to be 2% lower below that market rate. In year 2, the interest rate is going to be 1% below market rate, and then in year 3, the interest rate is going to return to full market rate. And so this is similar with the 3-2-1 buy down. In year 1, you're going to have a 3% lower interest rate. In year 2, you have a 2% lower interest rate. In year 3, you have a 1% lower interest rate. And then year 4 through 30, that is when you're going to have that full market rate. And so this is really a fantastic option if you plan to refinance when rates drop, if that's kind of what is trending and what is expected. Or potentially if you know that your income is going to rise in the next couple of years, you're going to have some more money to actually help pay a higher mortgage overall. So let's take a look at an example of a temporary rate buy down. We're going to assume here a $400,000 loan and a 6.5% interest payment. And so that's going to put your payment at about $25.28 per month. There are some other factors you need to take into account, such as what your down payment is, as well as taxes, insurance, that can change that monthly payment. But for the sake of the example, that's what we're going to go with. So when you're using a 2-1 buy down, your interest rate for the first year is going to be 2% lower than that 6.5. So you'll have a 4.5% interest rate in year 1. That puts your payment at about $2,026 per month. That's a savings of over $500 per month in year 1, $6,000 that year alone. In year 2, your interest rate is going to increase by 1% to 5.5%, and so your monthly payment is going to be about $22.71, and so that's about $250 less than what your regular payment would be, and so that's another $3,000 saved in year 2. And then by year 3, your interest rate is going to return to the full 6.5%, putting your payment at that $25.28. And so overall, as I said, $500 per month in the first year, $250 per month in the second year. That's going to put you at about $9,000 or more in savings by doing this 2-1 buy down option. Let's move on to a permanent buy down. So permanent buy downs are slightly different than the temporary buy downs. With a permanent buy down, what you're going to do is you're going to pay what are called points. You're going to pay these up front to reduce the interest rate for the entire life of the loan. And so this can get kind of tricky, but a good rule of thumb is just that 1 point. Paying 1 point means that you're paying 1% of the loan amount, which is going to reduce your payment by about 0.25%, your interest rate by about 0.25%. So for example, on a $400,000 loan, 1 point is going to cost you $4,000, which will then bring down your interest rate permanently by about 0.25%. And so permanent buy downs make more sense if you plan to stay in the home for a long time and you really want some stability. Let's take a look at an example here for the permanent buy down like we did with the temporary buy down. So on the same $400,000 loan, you have that same starting rate of 6.5%. If you want to pay 2 points up front, then that means you're going to have to pay $8,000 to reduce your interest rate by about 0.5%. So that's going to take your interest rate from a 6.5% to about a 5.9%. It's going to bring your monthly payment down to $23.66. So you're saving about $162 per month for the life of the loan. And so the break-even point here is about 4 years. So if you plan to stay in the house for longer than 4 years, then the savings that you're going to get out of that actually outweigh that upfront cost of $8,000. And remember that you don't necessarily have to pay all of that yourself. If you want to, you can, but you can also have the seller contribute to that if they are open to it. So which one should you choose? If you're still kind of uncertain, then hopefully this will help clear some things up. So you should use a temporary buy down if you expect to either refinance in a couple years, because that's when you think that interest rates will be low enough. Typically, we recommend refinancing when interest rates are about 1% lower than what your actual interest rate is at the current time to make sure that the savings make sense. You also potentially would use a temporary buy down if you want to just kind of ease into home ownership with lower payments early on, but just be aware that those payments are going to increase as those years, year 2, year 3, start to catch up. If you're thinking about a permanent buy down, this is a really great option if you plan to stay in the home for a long term and you want guaranteed savings. And so it's going to be a higher upfront cost, but typically it's going to take you a couple years to break even. And then after that, you are saving money in the long term. So really the key here is matching your strategy with the timeline and your expectations for how long you plan to be in that home. Let's talk strategy real quick, a little bit more here. So in today's market, the smartest move really is to often combine these strategies with seller credits. And so sellers and builders typically are more motivated, especially when interest rates are high, because they realize that it's going to be harder for people to get into the home and actually make that purchase because they just can't afford it. And so many of them are willing to cover the cost of the buy down. And so this means that you can either reduce your payment temporarily or permanently without actually spending much money, if any, out of your own pocket. And so this is really important. I think that if you're looking at new builds especially, they're pretty good at covering things like this. Depending on the market that you're in, sellers also might be willing to do so. But if and when the market heats up and maybe you're in a seller's market in your local area, then this strategy can be a little more difficult because there's typically more competition. So sellers are less likely to want to offer more money to you if they don't necessarily have to. But when it's a buyer's market, this is a really good strategy. And I still think that regardless of a seller or a buyer's market, it is a strategy that you want to pursue with your agent. So the best buyers out there are not just shopping for homes, they're really shopping to find a creative financing solution that makes home ownership more affordable for them. All right, quick recap here. So rate buy downs are a tool that help you lower your monthly payment. And so you either have a temporary buy down or a permanent buy down. The way that these work is that you are paying some money up front during the process of purchasing the home, and that's going to lower your rate. And so the temporary buy downs are going to lower your rate for between 1 to 3 years. So depending on if it's a 3-to-1 buy down or 2-1 buy down, but then they will get back to that market rate. Permanent buy downs, on the other hand, are going to lower your rates for the life of the loan. And so in order to do a permanent buy down, you're going to have to pay points, and a point is typically 1% of the loan amount, and that's going to lower your interest rate by about 0.25%. So both of these options can save you hundreds of dollars per month and honestly thousands of dollars over time. The right choice really is going to depend on what your timeline is, what your budget is, and what your plan is for refinancing just overall. So I hope that this has been helpful. Congratulations, you have completed lesson 6, and with that you've also completed module 2 on financing with confidence. I hope you are feeling more confident now about different financing strategies and terms. In module 3 though, which is coming up next, we're going to shift gears into house hunting 101. So in this module you're going to learn how to find the right home without losing your mind, because it can be a very stressful process. And so we're going to talk about how to shop smarter instead of harder. Please make sure that you subscribe so you don't miss it. Take care. Very quickly before you go, I just want to say thank you again for taking time to view these videos. I know the process can be very overwhelming, and so hopefully this is helping you feel more comfortable and confident in that home buying process. And so if you could do me a favor, I would really appreciate it if you could like and subscribe to the full Real Estate and Mortgage 101 series so you don't miss any more videos, because I have a lot more coming out, a lot more planned for you. And as a special treat, if you click on the link in the description box down below, you can access all of these Module 2 resources as well as other helpful guides and one-sheets, and that is my gift to you for free, absolutely, because I want to make sure that you are as confident and comfortable as possible with this process. Thank you again. Finally, once again, if you are interested in working with me, then I wanted to provide you with my contact information. So as I mentioned before, I am licensed as a realtor and a mortgage officer in Arizona and California. But if you are not in one of those locations, I do have referral partners across all 50 states and internationally. So feel free to shoot me a text, give me a call at the number on the screen, or send me an email, and I will do the best that I can to make sure that you are completely taken care of. Thank you so much for trusting me with this journey. Take care of yourself.